Yeah, got it. Okay, perfect.
All right, let's see here. 9 o'clock. So
Yeah, shall we start?
I think so. Good morning, everybody. Um, Welcome to the Simply Protein corporate presentation. Michael's going to actually run through the presentation because there's a lot of new faces on this call who haven't heard the story yet. So we'll do kind of a quick version of the corporate presentation, and then we'll open it up to Q&A to talk about the Series B capital raise, which is going very well. So I'll record this video, and then we're going to put it up on Simply Protein's YouTube channel. So we'll have a shareable link to pass around to anybody who wants to watch it again, or share it with other people who haven't seen it. All right. So with that, Michael, over to you.
Awesome. Well, good morning, everyone. Thank you very much for investing the time today. I'm always very, very grateful for that. I know your time and resources are very precious. So just wanted to personally thank you for investing the time. So as Jamie mentioned, I'll spend sort of 20, 25 minutes. I'll go through the presentation and then would love to open it up to Q&A. We're midway through the year right now. So we've got a pretty decent view of the year, and then obviously working on the building blocks and foundations for the next few years. So excited to share some insight to that. Okay. So the usual legal disclaimer as it relates to projections, latest estimates, etc. You've seen all this before, of course. So I always like to start with is kind of the journey. The Simply Protein, it's by no means a startup. It's actually been in market for about 15 years, but it was predominantly a brand only in Canada. And only really in the last couple of years, we launched in the US. But the brand kind of went through a transition. So it's Simply Good Foods Company, which is the Atkins Nutritionals brand, who owns Quest now. I worked for that company for 3 years and managed the Canadian portfolio. And there was an opportunity, including Simply Protein, and there was an opportunity midway through last year to go through a management buyout and acquire and carve out Simply Protein. And that's when Matt and Nicholas and Jamie and very grateful for many investors jumped on board, and we acquired the company from the Simply Good Foods. And it's really only in the last 2 or 3 weeks, actually, that we're officially done that transition. So as many of you know, you've probably been through this, standing up the company and going through all the vendor record changes and all that transition has, they're a great partner, but it's a complex exercise. So we're in a good, stable spot right now and have made that full transition. And now our strategy is all about the future. So F21 is really a stabilize and invest to grow year. And our strategy, and I'll share it with you, is we want to become the #1 plant-based protein snack brand in North America. And we've got the building blocks, we've got the investors and the management team and the board to do it. And I'm going to share a little bit with you around that, and would love to answer your questions as well. So a couple of highlights on the company, I think, particularly from an investor perspective, the things that are likely important beyond just the brand is things like our manufacturing relationships. We have a number of co-manufacturers in our portfolio, many of which we've had long-standing, deep relationships with. In the natural food space in North America, the more common model is an outsourced co-manufacturing and 3PL model. So we are in that state. So we're a very asset light organization. We don't have any debt or burdened P&L or burdened balance sheet around that. So, and in terms of historically with the brand, really its value proposition, what's unique about the brand is in the protein space, we can deliver 15 grams of protein with 1 gram of sugar and 150 calories. And that combination has held true for many years. Now, in the future, we know we've got to innovate outside of just bars and cookies. And I'll share some exciting opportunities we're pursuing right now. But that's been kind of the nucleus. And a couple other things. We're in the plant-based space, and I'm going to show you in a minute. This is a good sector to be in right now. If you're following, brands like Laird Superfoods or Beyond Meat, or, this is a very hot sector. I'm on the board of the Plant-Based Foods of Canada. We're also a member of the American equivalent. So we're active in the space. So as mentioned, I won't drain all this out, but you're probably reading a lot of the same articles that we're following in the industry. But retailers, consumers are telling us that plant-based protein, it's a mega trend. This is not a niche vegan, consumer trend. This is a bona fide mega trend going on in the space right now. When you have companies like Nestle declaring, the future of food is rooted in plants, that's a pretty bold statement for the #1 food company in the world to make. You've got Kroger, the #1 grocery retailer in the world, saying we're behind plant-based protein, and we're even declaring a new trend called ketotarian, which is a plant-based spin on traditional keto. So this is a mega trend. But that said, there are a lot of entrants coming in, a lot of brands coming in. It's a competitive space, but exciting. Like it is absolutely one of the most exciting spaces I've personally been in a long time. So what does that mean for us? So I mentioned we want to be the #1 plant-based protein snack brand in North America. But at the board, myself, the management team, we've set forth now a plan with a series of building blocks that I'll share with you to become a $100 million brand in North America and some international markets in the next 5 years. So at a high level, what do those building blocks look like? So for F22 and what our fiscal is, just to ground you in the timing, F22 would start September 1st. Okay. So over the next 5 years, we're seeing the growth come in 4 areas, and we've got a whole series of plans underneath these areas. But the first one is just building out our existing distribution, and particularly in the US. We're still very much a small brand in the US. We have some really good anchor accounts, but it's a significant upside on brick and mortar for us in the US. Like we're not in Whole Foods yet. We're not in Sprouts. We've just transitioned from pharmacy into the natural set at Kroger in 2 regions. So we're very much in the early phase of growth and a ton of upside. E-commerce, if we look at our e-commerce business today between US and Canada, we'll close fiscal 21 probably about 1.8 million, massively underdeveloped business. So we've gone through a significant exercise in the last 3 months, actually, of setting up agencies, brokers, internal resources around winning in e-commerce. So we're seeing that as a significant growth opportunity for the company. The other one is club channel. So in club in Canada, we've been in Costco for almost 5 years now. It's a substantial part of our business, but we are not in one region in the US. There are 450 Costcos in the US, and even more Sam's Clubs, BJ's. Club is a significant opportunity for us. We just signed our Costco broker literally last week. I've been working with them for a few months to kind of get us set up to attack the club channel in the US, and also very close on a Sam's Club broker as well. And then the fourth will be new innovation as a building block. And I'll share actually some concepts and things that we're pursuing, including kids in the US. So when you look at that, of course, the mix of these revenue projections may change slightly between those four building blocks, but generally strategically, that's where we're aligning on every trade relationship, agency, internal resources, organizational structure. All of it is aligned around these four building blocks. Okay, so I won't drain this one out. Just super quick, like any consumer package brand that you're invested in or reviewing, we're doing a ton of research. We knew that Simply Protein, the brand's been around for a while, so we wanted an opportunity to refresh and, in a way, positively reinvent the brand. So we set forth in October and did a bunch of quantitative and qualitative research, both US and Canada, to really understand right now what is on the minds of the mindful snacker in our category, and adjacent categories too. So here's the one or two insights that I think are meaningful, that are accelerating. Number one is consumers are looking for a lot more functional benefits from their snacks than maybe they had 2 or 3 years ago, particularly a lot more than they did 5 years ago. So things like energy, kind of that opportunity to focus, gives you clarity, gives you, feels like you get that boost for the day, kind of the fuel to get through the day. Those are expectations now within snacking. And we have the foundation to do that, but we've got to continue to innovate against those expectations. It's no longer okay to just have a snack that doesn't really have more of a sense of purpose with the consumer. And this is not the only category. I mean, it's happening in the water business as well, as with likely with Flow. A lot more functional benefits and functional expectations. So in terms of looking at our brand versus the competitive set, I mentioned a little bit at the outset around our sugar, protein, and calorie content. This is a very formidable list of competitors here. If this was the water chart, this would be the Fijis and the like. Clif, Kind, Larabar, RX Bar. These are $100 to $500 million brands, and they are formidable competitors. And what we're doing is continuing to innovate and ensure that we protect our low sugar, high protein, low calorie, fiber type formulations, and then do that in a plant-based way. Okay. So in terms of the category, COVID has not been friendly. It's has been friendly to a lot of categories, but it's been particularly unfriendly to the bar snacking category. I've been in the bar. This is my second role in the bar category, and I have never seen the category down, like ever, in 9 years that I've been in and out of the category. So to have a $2.5 billion category down 9% is significant. So we've continued to grow. We're starting to slow slightly, but we're seeing a rebound coming back just now through the rest of the fiscal, as COVID sort of loosens up in the US, as there's more of a normal on the go occasions. We're starting to see that rebound. So, and that's really positive. So we're still ahead of the category, but we're seeing the category is going to start to come back, which is positive. So hence the investment in e-commerce and the like, is to make sure that we're in front of the consumer at whatever occasion she's looking at. Okay, so innovation, definitely some cool, really, really cool things going on here. Let me ground you in sort of a couple of insights that we're following here. Number one is plant-based, right? Number two is though the bar category is coming back, and we'll see a rebound, there is a big opportunity for Simply Protein to innovate outside of just bars. We need to innovate in product format and packaging format. So, stand-up gusset bags, kind of in-home and on-the-go consumption in different formats is a really hot trend. We are not participating in that right now. And what I'm going to show you is we're about to get serious in it coming forward. So in our portfolio, you've probably looked at our website, et cetera. We've, as mentioned, traditionally been mostly in bars, kids and regular. We have a small cookie business and a chip business. But on the right, the big opportunities are, as mentioned, in different product formats: clusters, energy bites, pieces, breakfast granolas, protein balls, and RTD shakes. Those are the general concepts that we've started development on, and have even timelines for launch, which I'll show you in a minute here. Okay, so the first one is kids. Now, kids we have had in Canada for a number of years, but in the U.S. right now, the kids segment is the only subsegment of bars that's growing. Clif is a $92 million kids brand. Their Clif Z bar growing at 11%, whereas their regular business, along with the rest of the category, is off. So kids is a growth opportunity. So we're launching kids actually early summer, and here's our U.S. format here. Key points of difference versus Clif and other kids products is low sugar, plant-based, and we're peanut and tree nut free. So as schools reopen, as moms look for snacks, not only in home for their kids with low sugar, but on the go in lunchbox or in on a field or an arena, this is the sweet spot for our kids product. So a lot of positive reception. We're really just right now in category review, probably with 20 accounts right now. So I'd say by the end of April, we'll have a really good sense of where our kids business is going to go in the US. But the reception has been initially quite strong because of our point of difference and the growth. Here's some new innovation, even with a slight twist on our branding. As mentioned, there's an opportunity to innovate in product format as well as packaging format. So these are some concepts that we've been developing now for the last 3 months. I have a new product development person internally and an ops team that are really strong. And we're pretty lean internally, but this has been a big area of focus for us and a building block for growth. So the 3 working concepts we have right now are keto energy bites. Again, this is in a plant-based format, granola energy clusters, and omega-3 protein balls. So I'd say probably by our next call, we'll have a pretty good sense of which ones we're going to launch, both US and Canada. It'll likely be 1 or 2 of them. And they'll be in some variation of a stand-up pouch and kind of that grab and go, as well as in-home consumption. So the other one is ready to drink shakes. And in Canada right now, as you look across the landscape at plant-based protein shakes, there's very, very limited assortment and offering in Canada. The US is a little different. The US has a number of 3 or 4 brands that play in plant-based. You've probably heard of Orgain. You've maybe heard of Evolve, Vega, of course. Taste and texture, not great on some of those, but we're in development right now, and Flo is our co-packer and formulation development team. So we're actually 90% there on formulations across 3 flavors. But here's just sort of a preview and a snapshot of what the product could look like. And we're currently evaluating, for sure, at minimum, a Canadian launch in the fall, and then hopefully 1 or 2 strategic customers in the US as well. So this is really exciting. Like every person I've shown these innovation concepts now to 3 or 4 main customers, and the response has literally been fantastic. So, including Walmart Canada, and some brokers in the U.S., et cetera. So there's definitely, we're onto something here. So a little bit about our team. Just watching my time here. You see me there. I'm sure there's many of you I haven't met, but I'm a long-term consumer products sales, marketing, operations. I've worked for a number of global CPG companies, but really the last 9 or 10 years now, I guess, been more focused in the small to medium-sized natural food space. And I was very fortunate to spend about 2.5 years working with Nicholas, Matt, and Jamie at Flow. I joined Nicholas when the company had only launched for a couple of months. And yeah, it was amazing. I learned a ton from him. I learned a ton from a startup experience. And that led me then to be general manager of the Canadian business for Simply Good Foods. Paul Thorne, VP Operations, super seasoned supply chain and ops guy. He knows more about supply chain than I'll ever know. Really, really solid operator. I've got Himani, who's ex-P&G. I've got Grant, who's on contract with us in the US for sales. Hector, actually, who's a brand new addition just in the last month. Really seasoned, solid finance, comes from McCain. Jenny, HR legal, phenomenal partner for us in the business. She went to law school, so we have a kind of quasi internal lawyer. Patrick and Cindy on the sales side, really, really solid. I will say, as we look at our growth aspirations over the next number of years, we'll continue to build out. But the core of the team we have today, is fantastic. I've managed probably over 400 people in my career amongst different roles, and this is by far the most effective, amazing team I've ever managed. So it's great. Our board of directors, I kind of pinch myself every time I look at this slide. I haven't looked at it in a little while. But we've got Nicholas, who of course and I'm always very, very grateful for my friendship and relationship with Nicholas. He's a very important mentor in my life. We've got John Lederer, who many of you probably either know or have heard of, ex-CEO of Loblaws, and he's on the boards of Walgreens, Staples, Maple Leaf Foods. Joe Mimran, of course, just an iconic brand curator, just an amazing influence on the board here. Joe Jackman, of course, who we've engaged in the last 4 or 5 months through this sort of reinvention, rebrand that we're doing with the business, the repositioning of Simply Protein, the innovation, really active, great advisor, and a phenomenal agency, the best I've worked with, actually. And then Steve Spooner, really pretty amazing track record in finance. He's a director at Jameson, Decebo, and also he was CFO of Mitel Networks. I think he took that company public. So really strong capital markets. I think he's raised over $1 billion in the markets over the last 25, 30 years. So really, really strong, and for a company our size and our stage, this is, a pretty exceptional set of advisors. And we have a meeting every 6 weeks, and they're very engaged. Okay, so retail distribution and where we're going. So just quickly, when we transition out of Simply Good Foods, a number of our listings in the US at the time were in the pharmacy section, which if you're shopping, the Cliffs, the Kinds, the Lara bars, the RX bars, they're not in pharmacy. And the reason I think the US team went into pharmacy at the time was that's where Atkins was, right? And so those are the buyers they knew, the brokers knew those buyers. So what we've been doing is actively transitioning our brand over to the Better For You natural set. And I think our first win was in the fall with Kroger. We secured 2 regions of Kroger in what they call the fitness set. So that's their kind of Better For You natural set. And so, we've managed through this transition, and now, we're deep into category review right now. February, March, and April, as I mentioned, probably 20, maybe even 25 category reviews that we're doing right now. So feeling optimistic. I think, there's some general optimism about the category coming back. So from a future perspective, which is, I think, the more exciting part, we've got the rest of the Kroger regions to build out: Publix, Target, H-E-B, Meijer, Ahold, CVS, Trader Joe's. I mentioned the club business. And this doesn't even include e-com. So, we're on Walmart.com in the US, Kroger.com, Safeway Albertsons.com, and then of course Amazon. So that's a big opportunity in the digital shelf, in the digital space. So here's an example of our Amazon Canada business. I remember I was telling you how kind of underdeveloped we were. We're really starting to turn this on. And we'll go from a year-on-year growth. I think last year we were $150,000 last fiscal in Canada. We'll close this year at $1 million. And next year, we're just working through those projections right now, but 1.5 to 2 million in Canada. The US is $1 million as well. Next fiscal would likely be in the 2.5 to 3 million range. So you can see again that building block, big growth opportunities. This just gives you a bit more grounding in our e-commerce strategy. Our partners with Quiver and Sage Tree, those are agencies and that we've already contracted and working with against the retailers you see here. So big digital shelf focus for us. U.S. distribution, I already talked about the opportunities here on the prior slide. And again, it's kind of it's all upside. It's just really it's going to be the degree in which the retailers support the rebound in the bar business and get really behind the growth in our innovation. And that's what we're working on right now. And again, pretty optimistic about it, actually. This is just an example of some of our merchandising, and just to give you some visuals of that it's real, and this is what we do. Retailer influencers, social, obviously, marketing. This is where we've seen a lot of growth, particularly in the last kind of 8 to 10 months or so, and we will see significant improvement in this as we go into our next fiscal, as we're investing in all 3 levels of the funnel right now, particularly from an awareness perspective, and then of course at digital shelf and paid search, a lot of investment and resources behind that. Operations and production, I mentioned earlier, we have long-standing relationships with our co-manufacturers, and Paul does an excellent job of managing them with his team, and I stay pretty close to it myself. And we have contingencies. So particularly on our core business, we've got contingencies. We didn't see any material disruptions during COVID. So that's a good example of in the last year, I don't think we shorted one shipment due to COVID. So, staying close. Okay, so financial overview. On a year-to-date perspective, we've had a good year. So this is as of the end of Q1. Q2 we saw more of a COVID impact in Canada, particularly at Loblaws, Walmart, and Costco, and the U.S. same. But we're starting to really see that rebound now. So I'd say probably in the next month or two, we'll do another kind of reforecast of the year. But still confident, that we'll, be in and around our budget. So no material issues there. But certainly, Q2, there was more of a COVID impact than Q1. But again, for the year, every brand is facing this right now. So, but we're starting to see it loosen up, which is kind of the most positive news. From a balance sheet perspective, I mentioned earlier, we're a fairly asset light business, but we're in a very strong position on cash. And in terms of managing ARAP, kind of the general equity and foundation of the company is strong. So feel really good about that. And obviously, as we inject more capital into the business, the strategy here is, we'll lean into growth and accelerate growth through brick and mortar, as well as e-com and innovation and club, our 4 building blocks, but also keep a reserve of some cash in the business just as we go through kind of the next year or two. So I think at this point, it's probably best to I'll throw it over to Nicholas and Matt, and they'll start to talk to you a little bit about kind of the current valuation and some details about the round. And that'll be a couple of minutes, and then we'll jump into Q&A. I think we're actually kind of right on time.
Boom.
Not bad, eh?
Oh, you did within 2 minutes. Beautiful presentation, Michael. For everyone on the call, it's Nicholas Richenbach, one of the board members, and a very proud shareholder of Simply Protein. And I'm just super excited about what Michael and the management team have done with this incredible asset that we got last year. And when I look at the future of plant-based protein and snacking, and the company's positioning within the category, with the growth of the U.S. market and product innovation, I just can't help but get more excited about the future of Simply Protein. And as Michael highlighted, there's so many different growth areas that the company is diving into. We'll surely get on our trajectory to hit that 100 million goal by 2025. So with that, we are doing a financing round. It's called our Series B. And we're doing the financing round in conjunction with resetting our valuation and triggering a qualified financing round for the convertible note that we have with the Atkins Simply Goods company that we put in place last year as part of the acquisition. So it's a secured debt instrument, about $3 million US. And in that we can reset the valuation a little closer to market comps, and put qualified financing in place of the company. And then the second reason why we're raising that capital now is we really see that Michael and the management team can start investing what I would call growth capital into the brand and into product innovation to get the trajectory of the business moving towards that $100 million mark. And so we've announced a $10 million financing. There was some preemptive rights associated with the original investors. And so we've exercised those rights, and Matt will give you a detailed update on that. And then we've invited some new strategic investors that are on the call today, going across a very specific US strategy where we're moving towards a high growth area in the US, and we're surrounding ourselves with amazing shareholders from the US that will really help catapult the brand, put a little magic behind it, as they say. And similar to Flow, these are highly influential investors that are coming in that can really help us promote the brand across the US and in Canada as well, where we're really strong. So the valuation was set at about 3.2 times the revenue run rate. And the market comps for this type of company are about 4.5 times. So we left a lot of room and growth for the original shareholders, as well as the new shareholders going on. So it's a little undervalued as a part of that. Also, when you look at valuations, there's always a premium on an M&A transaction. That premium is roughly around 25%. So we brought the valuation down to 3.2 times just to take into account this qualified financing. But as we move forward, you'll start to see the valuation really follow more industry comps of 4.5 times at a minimum in the private and public market. A company like Simply Protein has seen valuations almost double 4.5 times its current revenue, some between 10 and 20 times, both in Canada and the US. So we're sitting on a very amazing growth trajectory moving forward, and in a very hot space with a very established company that historically has been profitable, and when we purchased it, and that had a lot of investment behind it. So we're going to continue that investment strategy as we move forward with it. So I'll pass it over to Matt just to give an update on the round. It has been wildly subscribed, as everyone can imagine, both from the original shareholders and new shareholders coming in. So the goal would be the people that we invited to the call will probably end up closing up the entire round, and we'll move to push the entire round closing within the next 10 days. Based on Matt and Jamie's ability to get all the subscriptions done and dusted. But so Matt, I'll pass it over to you, and you can give everyone on the call an update of where we're at and what your expectations are around the close.
Yeah, thanks, Nicholas, and really excited to be on the call, everybody. Sorry, my camera's not working. But yeah, so as Nicholas mentioned, we've finalized the preemptive rights period for this offering last week with the original shareholders, and there was a tremendous response. About 48% of the round of the 10 million round was subscribed to via that mechanism, which left about 5.2 million available for new investors. As of today, we have about 3 million of that soft circled, and that will be subscribed to by March 31st, leaving around just over 2 million for new investors in this round. Again, this is the first meeting we're having, formal meeting with outside investors, so I'm assuming that will move quickly. And yes, we're definitely expecting around a March 31st close, just to give people enough time, but commitments will likely be received this week from those participating. Yeah, so that's about the update. And if you guys have any questions, please feel free to email Jamie directly, and we'll be sure to get back to you in a timely way, as this next week will be the last opportunities for this round.
Yeah, Matt, we can open the floor for Q&A. We have about 15 minutes that we can do some Q&A if
Cool.
People have any direct questions for Michael, myself, you, regarding the investment company, performance, etc. So without any further ado, let's open up the floor, Jamie, to any particular questions.
Absolutely. So everybody, if you have a question, just take yourself off mute and ask away. So we'll open the floor, as Nicholas said.
Hey guys, it's Michael. How are you?
Hey, Michael.
Hey, I I had to join a little bit late. Will you be able to circulate a replay of this today?
Yes, Jamie mentioned at the start of the call, it'll be on a secured YouTube channel.
All right,
So
perfect.
Michael, you can share that with your with all of your group as well.
Perfect.
They haven't been able to make the call.
Great. Thanks so much.
Hey, Michael, it's Paul Pelton. Great presentation, thank you, and happy to be here. A couple of questions. One is, where do you see the international market going? And two, do you have plans to build your own manufacturing facility?
Yeah, that's a great question. How are you, Paul, by the way? Nice
I'm
to.
great. I'm great. I put myself back on mute.
Yeah, no worries. Great to see you.
Yeah, great to see you.
Yeah, two great questions, and I admittedly breezed over international. Like it, matter of fact, we're pretty active in that space. So there's kind of three main opportunities here. This is outside of the U.S., of course. We have a Costco listing in Australia that was part of the old company. So we have, and that's about a $900,000 business, actually, just in the Costco Australian regions. So we've had a meeting with the buyer directly and feel good about that business and expanding that out. But the bigger opportunities are the two other ones. So number one is China. So one of our investors, Jun He, has a fantastic import and export business into China, including a storefront on Tmall. So we've signed a contract with him, and I brought another brand along with me actually for that. And I have an international sales manager working on that relationship with Jun. So I think we are going to start shipping literally in the next 6 weeks to there. So conservative projections on that year one are around 200,000, 250,000. But we see a path with Jun's guidance, a path to sort of 2 to 2.5 million over the next couple of years, maybe 3 years. And then the third area is there's an export salesperson, as I mentioned, that I've worked with on and off for about 10 years. And we have already built relationships with an importer into the EU, as well as some countries in the Middle East. So we have actually our first shipment going to Bahrain, I think this month, actually. So, but the EU is the bigger opportunity for us. And the sales manager that I work with has really long-standing relationships with distributors and a master importer. So to put a bow around that, international business, if you take the Australia Costco business plus China plus the EU, that could shape up to be 1.5 to 3.5, 4 million over the next few years. So second question was, are we thinking of building our own manufacturing facilities? That's definitely not in the current design point for the business. The reality is the economics in this category don't pay out dramatically to do that. And I would rather use our precious capital and our investors' capital to lean into growth and continue to maintain strategic partnerships and keep that outsourced.
Hey, Michael, can I add a comment on that just for Paul? Hey, Paul, it's Matt speaking. Nice to see you.
Matt, nice to see your name.
Yeah, you too. So if you recall, Flow, I hate to bring it back to Flow all the time, but the reason why Flow had to vertically integrate and build out manufacturing was to get to that 45% margin from about 25%, right? Michael's in an interesting place with his business where he's able to arrive north of 45% via co-packing relationships. So that idea is actually super positive for his business. There's no real need to invest the capital to vertically integrate because he's able to arrive higher than normal margins via the co-packing world that he's created.
Yeah, I'm just wondering, you're up against some behemoths, Kellogg's and such in the category, and they do their own manufacturing, and there's a lot of margin, that can be gained with that. But I get your point. First things first, and maybe it'll be in the future. Thanks for the international rundown. I think that's a great opportunity. Obviously, U.S. low-hanging fruit, and continue with Canada is the biggest push.
Yeah, if we were at the scale of Kellogg, yeah, definitely. But I'll tell you, even there are brands, Paul, just to give you some comfort in this. There are brands in the 1, 2, and 300 million range in our category that even co-manufacture at that level. It's a little different. Because I come from a world where we're all self-manufacturing. It was a big adjustment over the last number of years, but just to Matt's point, it's the economics actually at our scale. The economics make sense.
One last question, just while I'm unmuted. The source of the plant protein. Do you plan to add other types of plant protein into the mix? And like, is it 100% soy? Do you want to put in pea protein and some of the other plant-based proteins?
Yeah, for sure. You're right. The majority of our products are rooted in soy protein. The good news is, particularly in the last couple of years, the sentiment with soy at the consumer level is not negative. There's always 1 or 2% of the population that either have a kind of a dietary issue with it. But to answer your question, some of the innovation that I showed you, I went through it quickly, but we're looking at blends of pea and soy. We're actually looking into oats as well. Actually, a couple of those innovations do have oats in them as alternative protein sources. So, and we are actually starting to develop a relationship with the Richardson Group, who are obviously one of the largest oat suppliers in the world. And we got a couple of calls with them, and they're helping us sort of think about how do we get the protein efficiency and kind of our guardrails, but do it in a way around oats. So more on that to come.
Hey, Michael, this is Jeff York. I have a question about channel strategies, just in terms of like selling the product into clubs, into conventional, into all these different types of retailers. Like do you have it in your roadmap that the different product is going to go into different channels? I know it's tough in co-packing, but just to keep everybody at bay, as opposed to just getting volume. I'm just thinking about value and value creation and where the brand is going to end up. That's just my concern.
Yeah, that's a good question. So is your concern that there's a specific channel that we may want to avoid, or a certain format, or?
Well, I'm saying anytime you sell to Walmart, you get big volume, but then they drag the price down, right? And then if you sell to Whole Foods or Kroger, and it's hard to keep everybody happy when you're going for volume, right? And because you're looking at product expansion, I would put out making your product different sizes for different channels, because I've seen a lot of people trip going for volume. They can't get different size product, and then they end up pissing off their customers because it's discounted in one channel and they can't show value in theirs. And I would put it out there in terms of like different types of product for different channels as a part of the strategy.
Yeah, it's an excellent point, and you're totally right. We're trying our best to treat club in particular, because that's where you run into the price value issue that you're talking about, where brands trip up. We're trying to treat club, as a business within a business, in a sense that some of the innovation and formats and price per 100 gram and some of the slopes will be different for club. And then on the food, drug, mass side, particularly in food, we'd have different formats. So we're not quite at a size where we can be more surgical than that.
No, I know it's difficult. It's just on the roadmap, right? You're talking about going to stand-up bags and things like that, and I would really put out to have different products for different channels, because everybody, you see how much business is going to Costco and Walmart now with the pandemic, right? And the conventional stores had their holiday this year. Now they're going to lap against these numbers, right? And they're not going to be nice. So you can do a lot of volume, but like it's where we want the brand to end up is all I'm saying. We want it to be somewhat premium, or do we want to do volume? And then it'll gravitate to the lowest common denominator, which is price, right? So
Yeah, it's a good point. I'll definitely take it really serious consideration and put a little more thought to, which innovation by channel and format by channel. It's good feedback.
Hey, Michael, how's it going?
Good, how are you?
I'm doing well. This is Randy Osei from the Athlete Tech Group. Connected with Matt, and Matt shared. Yes. I have some athletes and some of the representatives on this call who are interested in investing and also helping to promote the product as brand ambassadors and pushing the product to some of their business development contacts. Can you chat a little bit about influencer programs and brand ambassador programs that you guys are looking to do? I know I've seen some of them in the deck that have been spoken to, but influencers and professional athletes are two different things, if you will.
Oh yeah.
Want to give the folks on the call just some insight into what you guys think could be a great opportunity for some of the athletes.
I think from a marketing, by the way, it's nice to meet you, Randy. Thank you. And thanks for asking the question. From a marketing perspective, this is probably one of the single biggest opportunities we have right now. We, as a brand, we've not done had any endorsements or anything in this space you're talking about, Randy. And it's a big opportunity. So here's how I look at it. And I've learned a page or two from my friends at Flow about this. And we absolutely need to do something in this area, and we want to. It has to be, of course, the right brand fit. So I'm less concerned, about the exact demographic and, all this. I'm more concerned about the authenticity and, someone that, at least supports or is in some form of the plant-based space. And I think it's the biggest opportunity for us. And I'd love to talk to you guys about it. Matt's actually reached out to me even this week and said, hey, if you want to start having these conversations, we should do that. So I'd love to talk to you about it.
Yeah, just to add to that, Randy, thank you for saying that, Mike, because I think it's a huge opportunity as well. And Randy, just to be super clear, the secret for success around these type of deals is that they're organic, like Mike said. They're people that love the product. They're investors, so it's all organic, and then we make magic together, and we both win. That's kind of how it goes, right?
Absolutely.
So we'll continue, maybe even over the weekend and into early next week, we'll continue those conversations, Randy. And we'll figure something out.
Sure. And one other thing, we had some athletes join that were in China and in Italy. It's like 10 p.m. over there. I know we talked a lot about U.S. distribution and growth opportunities in those markets. Are we looking overseas into these other markets, seeing that everything is digital and e-commerce is essentially going to take over the world? Is that something that we're also looking at as well?
Absolutely. As I mentioned, the EU, the EU and China are the two single biggest international markets for us. And again, there's some Middle East markets that we're working on, but they're more opportunistic, Randy. It's EU and China. So if there's a partnership opportunity that would make sense for us, financially, and would be a fit for the brand, absolutely. I think that would be amazing, actually, for us. So.
My absolute last question. Sorry.
Yeah, go for it.
And I may have missed this earlier, but the capital strategy. I know there's a strategy to get to 500 or $100 million in revenue in the next 4 years. Is it then to possibly be acquired? Are we, trying to follow flow and IPO? What is the capital strategy from your standpoint as of today?
That's a great question, Randy. Michael, maybe I'll chime in real quick. So this financing round definitely puts the company on that trajectory to hit the 100 million. So that's the primary focus of this growth capital. And so it's going to give the management team all the capital requirements to be able to kind of change the trajectory, invest in our relationships in the US, expand our influencer celebrity strategy, and really kind of break the brand in the core verticals and adjacent verticals for customers with our new brand platform, which is really exciting. I think the tagline, Michael, what is it? Fueled by you?
Yeah, plant-powered fuel for all.
Yeah, fuel for all. And so it's really, really exciting on that. So the capital strategy is to put the necessary capital on the Series B into the company to get that trajectory moving closer to the 100 million mark by 2025. Now, with that being said, Michael and the board of directors are paying very close attention to both the private M&A market as well as the public market here in Canada, specifically because the plant-based protein space is one of the hottest sectors in the capital market in the better for you food and beverage category. I think Beyond Meat really kicked it off last year with their IPO and really set the tone for I would call maximum valuation on a mid to long-term view on these companies as they steal market share away from traditional protein and move it into a plant-based world. And plant-based snacking is one of the largest areas of growth within that. So we're paying very close attention to both of those areas. And now the last thing I can say with that is this is a 12-year-old, 15-year-old brand and company. It's had a lot of investment behind it to date, including the original acquisition of the company 5 years ago before Michael joined, and further the growth in the US market and the amount of money and capital that has been put into the brand. So it's a very mature company, although we acquired the asset last year. So it's brand new and sparkling for us. But this company is definitely posed for a strategic capital market discussion in 2022, and we're paying very close attention to both the public and private markets at this stage.
Thank you for that, Nicholas.
You're welcome.
Sorry, I have one more question. In terms of innovation, I know within the plant-based category, people are looking for a bit more wellness products as well. So like people are looking to find ways to fight inflammation and things like that. Obviously, CBD is a big topic. Is that something that you guys would look at, or would you guys look at other formulations that integrate into this as well?
Sorry, it kind of just cracked up a little bit there. Can you guys hear me okay? I'm sorry to ask the whole group of people here.
Yeah, Michael, we got you.
Okay, because it was just coming through kind of half cracking there, so I wasn't sure.
You want me to ask again?
Yeah, do you mind, Randy? Because I only heard half of it, and I'm probably going to give you a bad answer.
No problem. So was wondering, like I seen you guys, there's a protein drink that's coming out hopefully between 2022 and 2025.
Yeah.
Well, what's the group? Is Simply Protein looking at other innovation around inflammation? I know that's a really, really hot topic. Inflammation around CBD. If not CBD, would you guys be looking at other formulas or other iterations to your Simply Protein over the next couple of years?
Yeah, we haven't we haven't looked at something like inflammation. I mean, we've softly looked at things like adaptogens, still small though, a bit niche, and maybe something we can't compete in at scale. But you know what? It's probably a good new product development sort of idea to at least do some research on, actually, because you're right. I mean, there's so much being written about inflammation, particularly, you know, and I think that's one of the reasons low sugar has continued to be another mega trend that's definitely not going away. So I think it's for sure worth looking at.
Okay.
I agree.
Thank you.
Yeah, no problem. Thanks, Randy. Those are thanks for asking a lot of great questions there. Appreciate that.
Awesome. It's Nicholas again. If there's no further questions, we can. It's 10 o'clock. We're right on time again. So you know, from my perspective, thank you very much for everyone joining the call. You can follow up with Jamie and Matt on subscription documents. As I mentioned, that this will be the last call. We'll close the round down after this, probably over the weekend, and get all the subscription documents done and dusted, and close before the end of the month. Michael?
Yeah, ladies and gentlemen, thank you. I really grateful for your time, and thank you for the great questions and for allowing me to talk about the Simply Protein story. Appreciate it. Have an amazing weekend.
Great job, guys.
Thanks, Michael.
Thanks, everyone. Thank you.
Thanks, guys. Bye.
Ciao.